You're about to join Jerry Parker, Moritz Seibert, and Niels Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Moritz Seibert and I, Niels Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. If you're new to the show, let me start by saying welcome, with the hope that today's episode will trigger your curiosity and hunger for learning enough to check out the back catalog and listen to the past episodes that you may have missed. Like last week's episode with Rob, where we had a lot of really great questions that had been sent in, and where we also discussed how you can combine simple trend following models into a balanced and robust trading system, and a lot more. So if you missed that episode, I invite you to go and check it out. Also, let me quickly give a shout out to all of you who took the time to leave us a rating and review this week. And I really loved a couple of them that I want to highlight. One was from Sommelier from the US. I have a feeling I actually know who that might be. And he wrote, "Would you like to have a coffee each week with the trading legends? This is your opportunity." And maybe that's a good way to think about what we do, namely on having an ongoing and casual, pretty honest conversation of what it's like to be a trend follower. And then let me also mention a great one from Abby in India, who headed this 5-star review with the words, "The trend for this podcast is definitely up." So I love that, of course. And we're grateful to all of you who helps us grow by giving us a rating and review. Moritz, very good to have you back from your holiday. It's been a while. How are you doing? How are things where you are?
Yes, happy to be back. It's been a while. I skipped 1 month. I was enjoying a vacation. It's good to hear your voice again. Doing fine. I was actually on the Clubhouse with Jerry a little bit for a couple of minutes, maybe 20, 25 minutes or so this afternoon. Enjoyed that as well. So good to catch up with everybody.
Good. All right. Well, in terms of a market wrap, let me start by saying that Moritz and I are recording this on Friday, July 2nd. So it's a day earlier than we normally do, and therefore the week is not completely over. But as it stands right now, it has in some ways been a pretty uneventful week, with uptrends in equities and energies continuing, and a bit of recovery in bonds after the Fed members did their part to downplay the FOMC comments last week. And the latest US job numbers just released today, with 850,000 new jobs and a 5.9% unemployment rate, does not seem to have spoiled this party. But in the land of commodities, it's been a pretty interesting week, as many of them, especially in the grain sector, have made a good comeback after a steep sell-off in mid-June. So I noticed that markets like soybeans and soybean meal are up more than 10% so far in June. Lumber, of course, continues to trade with a healthy dose of volatility, although the net change on the week is pretty small. Bitcoin seemed to be stuck in a range, but I'm sure a lot of the listeners look forward to an update from you, Moritz, on this as well. And of course, last week, Rob told us that he's now has a small short position in Bitcoin, while Jerry the week before said he is still a little bit long. So anyways, Moritz, I'm curious to hear what's been going on in your portfolio in May and June, I guess.
Yeah, interesting. Well, before we start, interesting that 3 trend following traders have 3 slightly different positions in Bitcoin.
Well, there we are, yeah.
Rob is short, Jerry is still a little bit long, and Moritz is completely flat. So
right.
I got kicked out of the thing. But anyway, turns out I probably had a bit of a crystal ball last time we spoke. I remember we had this great run, or I had this great run. You had a great run. Chesapeake has, I think, a great run, or still has a great run. We just had this great time running trends since the end of last year. And I said, well, it's going to come to an end. Made all this money from the long positions in the grains and, Bitcoin and emissions, and was already preparing myself and stealthing myself for the drawdown that will come. And here we go. It came. I lost close to 6% in April, and then another 4% in May. Oh, no, what am I talking about? I lost close to 6% in May, and then another 4% in June, and I have about 12-13% drawdown, something like that. So from what I recall there, especially in May, there were days where all of the grains were kind of like moving south at the same time, and got stopped out of some of those and then had some give back in profits there. I mean, overall, I'm still up 23% for the year, so I'm not complaining. That's a pretty good number. But still, you know the drill. I now need to work myself out of that drawdown. I had a long position in lean hawks. I took a couple of notes. I had a long position in lean hawks, and that got stopped out. And Bitcoins got stopped out in May. Lumber got stopped out where I had a long position. Some of the bond markets reversed actually from short to long. Yeah, it's quite a mix. Some of the positions that I have in my portfolio, let's say they're notable because they are pretty long dated. They have aged. I still have them, and some of them are now more than a year in that portfolio. NASDAQ, SMI, still long. Silver is a long position that I have on for a long time. RBOB, so that's gasoline. It's a pretty long one as well, more than a year, 276 business days. So some of that stuff is fairly long-term long, and it's still working. It's, the gasoline market's moving up, so that's a great position. And some of the most recent ones, I'm now long the BTPs. I'm long the Bund future again. I've been short the Bund for a bit, but it hasn't been nice to me, nice in air quotes. Maybe on the short, I remember one roll and actually had some positive P&L on the thing. Certainly that short position in the Bund future wasn't an exit with a full loss. May have scratched at the end of the day. So yeah, but when I look at the paper here in front of me, I have my portfolio printed out in front of me. Pretty okay with the way that looks. Very diversified, quite a lot of positions on. More longs than shorts, but blended. There are some shorts and not too few. So that's good. I remember back in January, February, it was 100% long. Something like that. So it's all pretty cool. It's summertime here, trend following trading, drawdown. What the heck?
Yeah. And, as we all know, I think we talked about this last time we spoke, that I think you had one of the longest runs in terms of sequential positive months, right? So this is all normal stuff. So interesting. Good to get an update on that. The update I'm going to talk about on Done and my model is really mostly just because July has just started. So I'm just going to talk about the month of June since it just finished, really. Our trend following strategy, you could say, performed in line with the market correction. So we gave back also some of the early 2021 profits. Not too bad, probably more or less in line with you, actually, Moritz, I would say. And not surprising looking at the market actions for June. Commodities, with the only exception being energies, was really where most of the difficulties occurred, along with currencies. But also, in addition to energies actually doing pretty well, there were also gains in the equity sector, but not enough to keep our trend following strategy from recording a loss for the month, but still finishing the first half up almost double digits so far. The trend barometer actually picked up a little bit this week, finishing Thursday night at 48. So neutral, but in the positive end of that. So we'll see. I think performance this week's probably picked up a little bit, generally speaking. On the volatility side of things, you could say certainly late, the realized volatility in the S&P has dropped significantly. And I think currently the 1 month realized volatility is around 8.5%. That's really among the lowest levels since the crisis began in March 2020. And the last two times we've seen similar levels was in August 2020 and January 2021. And in both cases, there were a little bit of an awakening after that with some spikes in the VIX turning up. Our volatility strategy, actually, it did have a quiet month. As mentioned, uncertainty seemed to have left the equity markets and moved on to other reflation assets. But the program finished the month up about 1%. So we'll see. For my own trend following model, where I can always be a little bit more specific, it was an up week, but just staying with the month of June. The month of June finished down 0.7% for the month, up 13% year to date. Performance really breaking down with one group being up, which was the classical trend models, up 1.1%. The group 2 models were down 47 basis points, and the worst group was the fast reacting models. Group 3, they were down 1.33%, being whipped around a little bit in some of these markets. Sector-wise, best performance came from equities and energies, just like with the Done program. And the worst sector this month was really currencies, precious metals, and bonds. And if you drill down to the single markets, no surprise. Top 3, all equities, NASDAQ, SMI, and SPY. And at the bottom, we see the US 10-year notes, the DAX, and the British pounds. In terms of trading so far this week, not including Friday, but only 2 trades so far this week, going long a little bit of nat gas for one of the models, and also going long a little bit of sugar for one of the models. And then in terms of risk levels, the risk to stop, meaning if all positions got stopped out today, really, actually it would lose 11.57%, which is down a fraction from 11.7% last week. So not much changed there. Now, before we dive into another really cool series of questions from Frank and John and Mark and Babek and Andreas, I wanted just to ask you a little bit more, because I think, so when I think about commodities at the moment, and you and I really picked this up back in the summer of last year when we said, hang on, some of the grains are starting to break out, et cetera, et cetera. At the time, we didn't speak much about lumber, but I think lumber has become kind of the poster child for this reflation trade. Everybody focuses on that and look at that, even though lumber is not even part of the Goldman Sachs Commodity Research Index, as far as I'm aware. But anyways, lumber is something that people have noticed, maybe especially those who are building houses, that things have become much more expensive. Why don't you, Moritz, if you wouldn't mind, tell us a little bit about where the prices have been in the last year, sort of highs and lows, where it came off, and kind of how that was handled by your system, because I don't trade lumber. We don't trade it either at Done, so I don't really have a good feeling. But I think it might be a good sort of visualization of trend following in a sense, because that lumber trade has, or I should say maybe trend, has kind of incorporated both the good stuff and the fast reversal, so to speak.
Yeah, I do trade lumber, and I got long. The system signaled a long position. Let me see. I think I have it printed out here, so I can tell you when I got long. Well, I can tell you, 2nd of December of last year is when I got long.
Okay.
And I closed that long position on the 9th of June.
Okay.
So that was just a very nice run up, right? Remember the days when lumber was going limit up day after day, and I was sitting there, thank you, Mr. Market, limit up, and I'm long. And the next day is, well, thank you, Mr. Market, limit up, and I'm long. People were, I think, amazed when it went above $1,000. The peak, if I remember that correctly, was around the $1,500, something like that, $1,500 mark. I don't have the specific numbers here in front of me, but something like that I remember. And then came the day, all of a sudden it turned around, and pretty severely. It turned around by going limit down, limit down, limit down. Recovered a bit, I think, at the 1,200 level, if I remember that correctly, moving back up to 1,300, but then going down again with limit down moves. I think we're somewhere around the 700 level, probably a bit higher than 700, but something like that. So it has essentially halved in the course of 2 months.
Yeah.
Maybe 6 weeks, something like that, right? And I'm now short. So it's a great trending market for my portfolio this year. I don't want to...
That's great. And I think it's very educational for people to hear sort of a little bit about the times you got in and when you got out and now short. And of course, it is a bit of an extreme trend. I mean, it's very rare that we see a market move that much within 1 year, although it does happen once you start looking for these trends.
I didn't have a position reversal. I'm just looking. I can only say that because I have it printed out in front of me. So I exited the long position on the 9th of June, as I've said, and then went short in the September contract on the 28th of June. So about, what's that, 2 weeks later or so.
Yeah, cool. All right, well, we've got lots of questions to go through, Moritz, today. So what I'm going to do, I'm going to start out with a question that actually we also talked about last week. It's from Andreas, but when he wrote it, he originally meant the question for you and or Jerry. So even though Rob and I talked a little bit about it, I wanted to give you a chance as well to kind of just give your a few thoughts to that.
Mm-hmm.
And also because you do look at other managers as well. And the first question that Andreas was interested in is, is along the line, or the context is, how to justify a fee structure. And the question was, what long-term returns would you expect from a short-term CTA with a 3 and 30 fee structure? Any rule of thumb? And of course, I think it's better to talk about initially what returns do you expect from a short-term manager in general. I mean, probably gross of fees, because the fees are just a function of, whatever you charge. But so that was a question I wanted to pass on to you as well, whether you have any thoughts on this when you look at the short-term space.
Well, 3 and 30 is pretty high, regardless of it being short-term or long-term or anything like that. It's kind of like you're entering the Renaissance technology sphere here. So at the end of the day, I think it's about the net return. But 3 and 30, if I were to pay that fee, I wanted to have a very consistently high long-term return. If you showed me 2 or 3 years of just, outstanding annual returns and then saying, oh, well, that's worth 3 and 30, well, I don't know. Maybe that was a fluke, and maybe the next 3 years you're going to have a down year, or you're going to have down years, and you may have over-optimized stuff. So that's one thing. The other thing I'd say is, then if you are so consistently good as a trader, if you can produce such fantastic returns, why do you need my money to run your business? Shouldn't you be behind closed doors, tap dancing and just doing your own thing? Provocative question, I know, but I think it's a fair question. So, really, if somebody has the capability, see Rentec, they have closed the doors, right? If you can make 50% a year, Sharpe ratio of 2, 3 or higher, and you have that secret sauce, I don't have it, but if you have that, why do you shop that around to somebody else for a fee, especially if you're in the short-term space where things aren't infinitely scalable? This is a much more tricky trading business than long-term trend following, much more slippage sensitive and these type of things. And then finally, final thought on that is, I always put fees also in relation to volatility. If you're charging me a high fee on a low volatility product, that is not okay. If you're charging me, a 2% fee on a 20% vol product, that is an okay ratio for me. If you're charging me a 2% fee on a 5% volatility product, and by the way, these type of investments exist. I'm not making that up. These products do exist. And, just, do the math. If you have a 5% volatility and your Sharpe ratio is 0.5, then your expected return is 2.5% on a gross basis. If you're deducting 2% fees plus all the fees that come with the fund, blah, 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 you're essentially looking at a zero. So why would you invest in that? So I think fees have to be a function of volatility, and they have to be a function of alpha. And if the alpha becomes too high, the question is warranted, why are your doors still open, and why do you not do that just for yourself?
Okay, fair enough. And since I've already given my thoughts last week, I'm not going to spend any airtime on that today. The other question, and this is, of course, I'm not so sure whether it's really a question, but, I think the theme here of Andreas was really, the pros and cons of this relentless research versus kind of simpler dollar cost averaging a CTA or broad equity market. And I don't want to go into naming names again, Andreas has mentioned, but I think what he was trying to say was that you do see people who talk a lot about things they're working on, changes they're making to their model, et cetera, and it can certainly sound pretty, it can sound interesting, it can sound sophisticated, but then at the same time, he's saying, I'm picturing, and in this case, he was using Jerry, sort of laid back Jerry with ample free time, and just using very simple rules, and versus probably a little bit busier Rob, the professor, with many variations and hundreds of backtests. So that's just kind of to give you a visualization. But it is, in essence, it's really the pros versus the cons of doing a lot of research and changes to your model versus sticking pretty conservatively with something that seems to be pretty good, but maybe it's not the best.
Yeah. By the way, I'm pretty sure Jerry is doing the same amount of research as Rob, I, or you. He may be doing it in different form. The fact is he's thinking about it. I'm pretty sure Jerry thinks about trend following each and every day. And, sometimes more, sometimes less, but it's on his mind. He thinks about it, he conceptualizes it, he understands all of these things, but I don't think that he's sitting still and, not moving forward. His head is working, put it that way, right? He's thinking about it, looking for improvements, questioning things, getting new perspectives to the extent that's possible. But so that's one way of researching too. You don't necessarily have to program every idea that you have into a Python script, which is I'm not sure if that is the professor type of thing to do, but oftentimes this is a lot of wasted time because it's very easy to then just take one idea because you've read about it and immediately put it into code and backtest it, et cetera, whereas you could also, maybe this is what Jerry's doing, think it through. Does it make sense? Is that what I want to do? Does that fit the trend following mantra? And maybe come to the conclusion, you know what? It's not even worth backtesting that thing. I'm not going to touch it. I don't do it. So you get to the same endpoint, but with two different research ways. One is to put it all in code and see what the numbers say. And the other one is to, think it through ahead of time and, conclude for yourself that it's not worth pursuing that path. So I guess we're all busy with trading and trend following, but in different ways.
Yeah, no, I think that's a good that's a good way of looking at it. What I can say from personal experience that, certainly at our firm, we have a decent sized team of researchers. And so we look at a lot of things. And obviously there's always something that needs to be kind of done, reviews, et cetera, et cetera. But when you look at the time spent and the actual changes that ends being approved to go into the system, it's very small. Because at least that's our philosophy, is that you really want to make sure that you're not just trying to find a short-term fix for something that looks great in a period of, say, February 2018 or February 2020, but actually over the long term, it's going to cost money to implement. So finding things that actually are truly improvements to a model, and maybe certainly when you've been doing it for a long time, is really hard. But as you say, it doesn't mean that we don't think trend following 24/7. It just means that we want to be absolutely sure that we're actually adding value at the end of the day when we make a change. And also, I think people should be aware that making a change to a model has its own risks, right? I mean, who's to say that you get it right and then, you find out 2 years later? Yeah. So
look, I mean, it's as far as I'm concerned, when I knew almost nothing about trend following, like when I started, right? So that's day zero. You open a book and you read trend following, but you don't know how it works. So you know really nothing about it. You start with that one. You try to understand the simplest things, and even those things are complex when you first read about them. Sure. But you get them, you put them into an Excel spreadsheet, you put them into MATLAB code back then, and get your head around it. And then you're at that point in time, still the younger Moritz, between 25 and 30, I've probably reached peak complexity, which was completely unnecessary because you understood the basic stuff. And then you thought, well, I'm going to outsmart these guys and show them a trick or two because all that stuff is very simple. So I can do much better, right? And that, I think everybody is almost going through that. I'd be surprised if people don't go through that phase where they're looking to add complexity to their system. Well, let me rephrase that. I don't think they're looking to necessarily add complexity. They're looking to add things that just improve things and make them stand out, right? To get something in return. I've made a change to the system. I've done something different that is better than what everybody else has done before me. But normally the result is additional complexity because you're fitting things, you're adding parameters that shouldn't be there. You're playing around with the system, you're using different rules, you're destroying your sample size without knowing it. That I've been through that phase, and that I think was peak complexity. And ever since that point in time, I'm very busy Not very. I'm just busy and focused on dismantling my system. And I think I've achieved that pretty well to a certain extent at least, which means I'm taking all that stuff back down so that when I look at where I am today, I'm not necessarily back to T0, everything super basic. I still have essentially my own DNA in my trend following trading system and the way that I do it. But when I take a step back, it's essentially a combination of relatively easy to understand, simple things. None of them individually complex, none of them unexplainable, none of them counterintuitive. And by the way, I've added a spread trading system to my trend following system. And for years, really, I've looked at that thing. How do I trade spreads? Which markets? How to get in, how to get out, what contracts, same markets or cross markets, position sizing on spreads. I think I had it overly complex because it was probably a necessary journey for me to go through that because I needed to, look into every corner with a flashlight and see what's there and probably also avoid making silly mistakes. But it took me a long time. And when I look at it now, it is essentially a relatively simple thing again. And that makes me happy. That makes me, in a way, confident that it's probably okay to run with it because it's simple enough. It's not too weird in a way. It's maybe a bit too early to say because I don't have too much of a live track record on the thing, close to a year, something like that. So yeah, don't want to sound like this is done and dusted and that's the way it needs to be done. But it is a simple system. And by the way, it has stabilized my portfolio in May and in June quite a bit. Without that thing, the pure directional trend trading system that I use, I would have an even worse drawdown.
Yeah, but I think you say the magic words here because I think a lot of the complexity that people end up introducing to their trend following systems, and we see that I think with managers as well, not just people who want to do it for themselves, stems from this fact that you mentioned. It stabilized my returns, right? I think we live in a time where change and volatility is kind of the enemy to some extent. We obviously know that everyone prefers, stability, and I understand why that is. But I think in particular with the financial market, since the crisis we've had and seeing the intervention from central banks to stabilize things, I think that it's really become a quest from many investors to avoid unpleasant volatility, avoid recessions if you can, if you're a policymaker, and so on and so forth. And so this is what I see, at least most people do, even a lot of our peers, is to introduce things that, and they of course do it with good intentions, but it is to try and make the journey more pleasant as for the investors. And sometimes people succeed with it. I'm not saying people don't, but it is really hard to do, and sometimes just raw trend following like we saw last year. I think last year was a good example where really that came back into fashion because you had enough big trends really to capture using relatively simple techniques. And in the long run, we've talked about Bill Dries a few times, you and I, and of course he retired. I think at least his track record seems to have been archived.
That's right.
Yeah. So, and if you look at his track record, it's not for the faint-hearted, but it's a solid track record. And I think he's finished pretty much at an all-time high. I mean, his timing couldn't be better. So, but it's just not for everyone. And of course, as a business, it never became a real business in terms of size because most investors want the returns without the volatility. So I think a lot of research is going into that, trying to resolve that, but it's really hard. And in most cases, we're just fooling ourselves because at some point that's going to come back to bite us if we make too many. If we deviate too far away from trend following, it's going to show up somewhere down the road, I think. But anyways, speaking on trend following, I want to move on because we've got quite a few questions today. There's a question from Mark, and I think Mark, what he's looking for, in general speaking, is kind of ideas for one, how to think about timeframes. We often talk about short, medium, and long term, and what do we really mean by that? And also, if we can talk a little bit about the timeframes we use in our models, what would they be? So that's really the gist of it. He does say that he himself is looking at about 6 months in terms of look back period. And he writes, as I assume, it's the best compromise between short and long-term systems and want to get 90% benefits of trend following with the simplest system possible. I don't use stops, either long or short, always based on the 6-month-ish channel breakout. What are your thoughts in terms of the definition, short, medium, long term, and where do you find yourself in terms of time frame? Just ballpark numbers, of course.
Yeah. There is no definition. There is no definition of short term, long term, or medium term, right? It's not objectively defined.
How do you think about it?
Yeah. I'm probably hostage to what the industry thinks it should be. Most people think short term is something like in the 1 to 3 month space. Put it that way. Medium term is 3 to 6 month holding periods, and then everything above that is long term. But looking at your face, it sounds like you disagree, which, to me means, see?
Well, short term,
we don't know what it is.
I heard you say short term, 1 to 3 months. I actually thought that was a little bit too long.
That was medium term for you?
Yeah. Well, no, but when I think about let me turn it around here. When I think about some of the best short-term managers, and I really don't think that there are that many of them, both you and I know probably both of them that we're thinking of here. I'm thinking days here. I'm thinking like 1-2 week max in terms of trade length. That's my impression of what they do. It's not to say that you could never trade that lasts longer, of course. On the other hand, I will give you that if I think about medium term being 2 weeks plus, that seems a little bit short because that doesn't really seem like medium. So I do agree it's a bit of a gray area.
See, the two of us are confused, right? But I mean, let's just name them. Grable, for instance, right? That is a short-term CTA, but it is not a pure short-term trend following CTA. They have mean reversion models, they have counter trend models, all sorts of things. There's a full basket of different strategies that they combine. I think they're doing a great job with that. Looking at their numbers, that's the reason why they can, I think, have like 1, 2, 3 day holding periods. It's because they have these mean reverting systems and that type of stuff. But imagine running a pure trend following system on a 1 to 3 day time scale. I've never got anything like that, net of costs, net of slippage. So to me, short-term trend following in the 1 to 3 day time frame is that just isn't there. It kind of like that. That's why I said short-term trend following is probably 1 to 3 months, and then maybe for me, then the medium-term part starts and it goes out to 3 to 6, 9 months even, and anything longer than that is long-term. So I'm definitely more at the end of the medium term, and then going into the long-term spectrum with my trend following trading. I don't have short-term trend positions.
Sure. Yeah, so you also asked, Mark, specifically about the 3 groups that I talk about when I refer to my trading system. And this is a little bit from memory, but group 3 definitely are the I call them the fast reacting models, because they're there to kind of step in if things really get hairy very quickly. And they are really in the 2-week time frame in terms of look back period, kind of 10 trading days. That's what they would look for. The group 2, I would say probably medium. I would say they're probably medium-term models. Keep in mind they're long biased, and that might also actually influence the choice you have for timeframes. But I would say that they're probably medium. And then group 1, which is what I call the classical trend, there you can think about that, I think, as kind of the classical long-term breakout style systems. And also, just to make sure you kind of, and there will be, because it's a breakout system, there will be a large neutral zone as well. Like Moritz said with his lumber trade, he didn't go straight from a long to a short. It's same here. For me, classical trend often has a neutral zone, which you can either have as a breakout system, or if you use several moving averages, you can get a flat position from time to time. So I would say think about it like that. But I appreciate your question, Mark, and your comments. Then we're on to a question from Frank. And Frank says, thanks for emailing your book. I've been a subscriber to your podcast for about 2 months, and I find it very interesting and insightful. How and why I found your podcast started with my interest in Commitment of Traders report. I started to track only a few months ago the open interest and volumes of long and short contracts of solely the non-commercial trades of currencies. From there, I went down the rabbit hole and discovered your podcast. I have a question for you if you don't mind, but I apologize upfront that I'm not a long-term trend trader because I actually enjoy scalping. Anyways, each week I like to estimate or form a bias which I will not trade against. For example, if I determine the US dollar trend is bullish and the euro is bearish, I will consider the euro dollar trade short only when my setup signals a play. To form the trend bias for the week, I will consider if long contracts and short contracts are increasing or decreasing from the week to week of each currency contract of the COT report. I'm just trialing this out for a few months, and so I'll see if the strategy has any merit or if it's a fool's errand. But my question is, how much does the CTA industry value or consider changing long or short positions as the volumes change over time? For example, just looking at non-commercial long positions in the yen, interest has virtually halved from January till now, while shorts have quadrupled. For me, that's bearish. If I see the US dollar gaining strength in the next few months, then I think I know what to do. Anyway, would love to know what importance or not you place on the COT reports and if it's wise or not to single out just the non-commercial stats. All right. Well, thanks for the question, Frank. Your thoughts on the COT reports, Moritz? I know you don't use them directly, but...
That is true. I do not directly use numbers from the COT, so the Commitment of Traders report by the CFTC, which comes out weekly, by the way, I think based on Thursday data. But I do have a dashboard, which I programmed, or which essentially my two quants partner Moritz programmed for us. So we do look at the stuff, but we don't have it integrated into our trading systems. The reason we look at that is because it highlights interesting markets, and it highlights markets it can highlight markets which are at risk of a reversal. So let me give an example. We're only looking at the simplified data, which is the commercials, and the inverse of the commercials is the small speculators plus the large speculators. There's different versions of the COT reports. There's a version that includes options data and index hedgers and all that type of stuff. But we used the basic legacy data, which is commercials, and then the small and the large speculators. And what we're looking for is essentially the speculators, and that, by the way, includes the CTA industry, the trend following traders, to become overextended or overly largely positioned relative to history. So they have a large relative long position in, for instance, we had that recently in cotton futures. And the commercials were short. The commercials who allegedly have good knowledge of the physical market because they trade in that market to hedge. And by the way, I'm no expert in the cotton market, not at all. But what was observable there is that there was large participation, larger than usual participation relative to history from small and large speculators, and the CTA industry is a part of that. So what that means is, once everything's long, and they're so largely long, who else is there left to go long, right? And then what can happen if the market stops going up, if it turns around, that trend comes to an end, there's a lot of futures positions that are at risk of being stopped out because the market is overextended, right? So the market turns around on a news piece, or maybe just because the market wants to turn around. And then these positions will get stopped out or closed out because losses appear and these type of things. Again, it is not an integral part of my trading system, but maybe at some point I'll do something with it. I don't know. 90% chance I won't, but maybe 10% chance I'll do something with it at some point in time. There is information there, but there's also many eyeballs looking at it. We're not the only ones. I mean, the stuff that I'm talking about is not four-dimensional chess, right? It's other people have figured that out as well. But maybe not too many are doing it. And maybe there's still room and still information that's valuable for us to see. So for a trend following trader like myself, that could be interesting in the way that I, could handle stops or something like that, and, handle exits. I don't know. I really don't know. But we have a dashboard that shows the markets which are at the highest risk.
Yeah. No, I mean, and it is a tricky one because, as you say, there's clearly some. I mean, it's very clear to see that sometimes you can use that as an early indicator or a flashlight or something like that. Maybe you could even think about it as a filter to a model. But again, how much sample size can you get? How reliable is it? That's really tough. What I will say, and it's actually also something I'm going to mention as my pick of interesting content I came across this week. But I will say to you, Frank, that maybe, and it's not directly related to this, but I was listening to the latest podcast of Jesse Felder, who had a guy called Michael Oliver on, who's a momentum guy, and they talked just about momentum. And again, I can't remember all the details, but he did talk about, he was using different kinds of momentum and lining them up and so on and so forth. And as a trader, if you're not wanting to run a diversified CTA, as a trader, I understand the idea of having a bias. I understand if you think the trend is up, you're only going to take long signals. I understand that. It's not how we would trade as a CTA, but I understand the concept of it. So maybe you should go and check out that conversation that Jesse had with Michael Oliver, and there's maybe some momentum ideas in that. Let's move on. This is a short question that came in from John. Actually, it's originally a question to Jerry, so I might post it next week when Jerry joins. And it's how much margin he was using back in the day as a turtle when he was putting out 200% yearly returns. So I don't know the answer to that, John, but we can answer it from Moritz's point of view and from our point of view at Dunn in terms of margin to equity, what is normal. And I would say from our point of view, I would say typically, on average, probably 20 to 25% is how I think of the margin utilization in our trend following strategy, the original version of it. Of course, it can go higher from time to time if there are lots of trends around. It could go lower, of course, but on average, I think that's the range we operate in. I don't know about you, Moritz, where you are in terms of margin utilization.
Slightly higher, but depends on the number of positions that I have on, obviously, but something like that. Now, by the way, that I've added the spread trading,
right?
The spread positions, they get netted, not fully, but to an extent. So I now find myself having actually a longer positions sheet because of those spread positions, but only a marginally higher margin utilization.
Okay, cool. All right, now we have a long question, which is divided into 3 sections from Babek. So bear with me if I get it wrong when I read this long question. So here we go. I've been a regular listener to your podcast for a number of months now, and I'm also working my way through all the episodes. Having listened to many episodes now, I'd like to thank you and your regular and irregular guests for putting in all the work required to produce such a wide-ranging set of topics, all related to systematic investing in one way or another. I have now been a portfolio manager for about 30 years myself and have close to always been a big fan of rules-based investing and actually allocate a risk budget to trend-following models in my portfolios. Having said this, I would highly appreciate your thoughts on the following 3 aspects and feel free to include this in different episodes. One may say that individual asset classes, for example, equities, fixed income, foreign exchange, do have their very own and specific high-level trading characteristics. For example, I'm strongly inclined to say that the free markets, society equity markets will structurally trend upwards while they, every now and then, experience massive drawdowns. Probably similar things can be postulated for other assets. Having said this, I tend to think that it may be legitimate to have quite different approaches to different asset classes. Now, if I've gotten this right from all the episodes I've listened to so far, you seem to be more in the camp of same approach in all markets. Would be very interesting to hear your views on this. So let me jump in here first, Moritz, because I have a feeling where you're going to come from on this. But I don't disagree with what you're saying here, Babek, in terms of, one, I do agree that I think it's fair to say that markets are different. And if you ran some kind of backtest on different sectors, you would find that those sectors would pick different set of parameters. I'm also, on the other hand, a strong believer in this, we trade everything the same. And I think in particular, maybe in trend following, I think that's very warranted. Now, having said that, if you've listened to I think I did it in December, this last weekend of 2020 and the first weekend of 2021, when I described how we had thought about the design of the trend following model that I refer to, you will find that not all the models trade all the markets when I talk about group 1, 2, and 3. So there is a little bit of that, but it's not necessarily meant to be some kind of optimized version of that. But then I've also discussed with Rob recently that when it comes to shorter term trading and shorter term models, and one thing that I've been doing in my spare time and working on, there seems to be, I think, a lot more scope for trying to do things a little bit different. For me, it's more like I prefer to say, okay, I'm not going to completely go into one camp in terms of saying, okay, I'm only going to trade equities this way and bonds this way, et cetera, et cetera. What I like more is to say, okay, I'm going to take some of my risk budget and I'm going to trade everything the same, just like I would do in the trend following system, or Jerry does, Moritz does. But then I think it's also fair to say I'm going to take part of my risk budget and I'm going to find another set of parameters that are more in tune with, say, sector risk. So you say you might have the same parameters for equities, you have the same parameters for bonds, but they would be different from equities, and so on and so forth. And then I'm actually also, when it comes to shorter term models, I'm also inclined to believe that you can allocate a small portion of your risk budget to parameter selections based on individual markets, because I like the structural diversification. I think that's what it gives me compared to just saying I'm going to trade everything the same, because I'm a strong believer in diversification. So I'm thinking, so why wouldn't I want to diversify some of the risk based on different parameters? And I actually think that you can. I've not done the testing on a trend following portfolio with longer term time frames, so I can't say whether that's a good idea or a bad idea. But I think from what I've seen in the shorter term space, there is more scope to allow the models to be a little bit more unique, if I can put it like that, or applied more uniquely. Because I think if you get into the short term space, I think the rhythm of the market is actually more important than if you're a longer term trader. And so I think your results will be better if you allowed for a bit of flexibility. Anyway, that's my thoughts, Moritz.
I think it makes sense to combine different systems. But as far as I'm concerned, I like every system to be a closed system defined by itself and doing the same things. So if I have one system, then I'd like that one system to use the same rules, the same entry rules, the same exit rules, the same initial stop rules, for instance. Where I allow a deviation is not in those entry and exit rules. I do have deviations in terms of position sizing, but not in terms of entry and exit. So this is what we've spoke about before with, the correlation matrices and recognizing the fact that some markets are just linked together. Some of the crude markets are linked together and some of the grain markets are highly correlated. And I need to be cognizant of that fact. And I want to represent and reflect that condition in the way that I size positions from a essentially risk management point of view without destroying my sample size. But that's it. That's a closed system. I encapsulate that. I put that in a container and that runs by itself. If I now want to do something else, a different system, different parameters, if you want to call it that way, then I would put that into a new container, a new box, all by itself again, with a unique rule set that applies to all the markets in the same way, and then run that system next to the first system. And there, in that way, combine a number N of systems, if you will, to increase diversification across the portfolio.
Yeah, no, definitely. And I think different systems, different styles of trend following, I think that's something we certainly do on our side as well. I mean, blending different styles of trend following, that makes also a lot of sense. So great question. Next one. Second, with regard to the above, I like to have my models designed to capture the asset class specific characteristics without even coming close to curve fitting. For instance, this implies acting rather fast when it comes to closing longs, as relevant, i.e., painful losses tend to happen unexpectedly and to be fast and brutal. On the other hand, we kind of know from experience that the way back up following a meltdown is tedious and slow. Of course, there are exceptions, as always, like February, March 2020. I like to compare this with climbing up a mountain, something the two of you can probably relate to given your location. On the way up, we typically need a few breaks. At the top, we better make no mistake, as this can lead to extreme pain. If we manage to deal with this with our rules, we kind of already have a built-in stop and hence can exclude explicit stop based on other approaches. At least if and when we have a long history of trades and a sufficiently consistent return distribution based on which we can derive a solid feeling for what the downside risk of the strategy is. Any thoughts on this?
Sounds to me as if he's trading a lot of equities, where it's certainly true that you're falling off a cliff and then you're slowly working your way back up. I don't necessarily see that same type of distributional behavior in the currencies or in some of the commodities where, sometimes there's massive spikes to the upside and, the move to the top side is really quick and fast paced. And maybe then it trickles down a bit from there. So all these markets are different, but yeah, in terms of equities, it's certainly correct. Look, I don't do that. I do not have a different type of stop behavior or getting out of losses more quickly in equities than in other markets, or because I'm losing a part of my open trade profits. It's probably what I've said before with Moritz being at peak complexity. That's probably stuff that I looked at back then. I skipped that and took that away from my system and liberated myself from that, accepting more volatility in return for better returns.
Yeah. So my answer to this, Babek, would be that, first of all, it seems like you've done a lot of thinking about this, which is great. So I appreciate your thoughts. The way I ended up doing it in my own trend following model would be to say, okay, so I agree with you. There are a lot of characteristics you can find. The question is, can you find something that you can apply? And the way I've dealt with it, you could say, is really to use different exit rules inside each of the model. But the model or the system will always pick the stop closest to the current price. So one particular model will trade everything the same, but it won't just have one simple exit rule. It'll have several. It might even have 3 different exit rules that I think make sense to have. And some of them will react very quickly, close to a high, for example. But in any event, to have the safest portfolio, in my view, in terms of avoiding, big drawdowns, it will always pick the closest stop on any given trade for the day. It might not be the same stop rule that generates the stops within the same week. It can be 3 different stop rules, but it's always going to pick the closest. So I think you get the picture. I think you can be a little bit creative when it comes to these things without deviating from the structural robustness of your system, I would say.
Just always bear in mind the cost, right? I mean, these things which look costless, because you're tricking yourself sometimes when you say, oh, I'm using the stop that's closest to the current price or to the last close, the last settlement price, because that reduces my risk and it means the smallest give back of open trade equity. So I'm more protected. But think that path forward. Imagine that stop gets hit. Sometimes it happens, and you need to figure out how often that happens, that the market then turns around. So you've got kicked out of a position. You no longer have the position. I'm not sure what type of entries you're using, but as far as I'm concerned, if I'm kicked out of position, there's no immediate mechanism that forces me to get back into the position. I can be flat, and many times I will be flat before I open a position again. So that means I've lost the position. And not having a position can also be bad. Having a position can be very valuable. Or I say it probably is a value. No, I don't want to. Let me rephrase that. Having a position is valuable. not can be valuable. It is valuable because we have a statistical body of evidence in the way that we trade, that with all our positions and knowing their probabilities and their expectations, which are essentially the same across the sample size that we've looked at, we have determined and we can conclude that having a position is a valuable thing. So I don't want to be kicked out of a position for no good reason. And good in air quotes here. That can be a good reason to have a tight stop. But it can also be good to keep the position and accept the larger give back, to keep that valuable position and then ride it again. Because that also happens. That is definitely part of the real world path distribution of, stock prices and commodity prices and currency prices, and it happens over and over again, right? And that is, I know I'm beating a dead horse here. This is the thing about this open trade equity thing, where I look at that in a different way when I have open trade equity, and that's just me. That is money that the market has given to me. I know that, I'd like to keep as much as I possibly can. That's not the question, but I can run with that money.
And I don't disagree with you, but the way that I operate differently in terms of my trend following model is that I have many different models in the program as a whole. So I'm not just diversifying in terms of time frame. I'm actually also diversifying in terms of different trend following approaches. So it would be very unlikely that just because one stop was hit for one model that I would be completely out of that market. Because I agree with you, you sometimes need to let the market, find its footing, and off you go again. So this is just, again, to get most diversification in terms of entries and exits at the end of the day. And of course, sometimes you will get completely out of a market, and so you should. But I haven't found it a limiting factor. But you're right. I mean, you can do, obviously, more research in terms of, okay, but what if I didn't use that rule? Would I have made more money? But then, at some point, you just have to pick your poison, so to speak.
The thing, that I want to make as a final point on that, I think if you're using 3 exits, you have cut your sample size. You've reduced your sample size by 66%. You can break that down into say the entry rule is the same, right? You now have 3 systems, same entry rule for all 3, but one system exits at exit number 1, the other one at exit number 2, and the next one at exit number 3. If you combine that all in one thing, you have 3 exits. And there is no longer just that one exit that defines your sample size. You now have, essentially, if they're equally likely to get hit, you have now a system that has one entry and many different exits, but the sample size for each of the 3 exits the expectation is 1/3. See what I mean? I've used bad language, I guess. I should have made that clearer, but you are reducing exit sample size. And the question is that what you want to do? Or would you rather say, I have a very robust sample of exits because it's always the same exit. There's only one exit to choose from. And then I can look back on a couple of thousand trades and just look at the statistics, not at the equity curve, not at the drawdown curve, just at the raw statistics of that trading system. And those statistics will have a more solid footing, I would say, than a system that has multiple exit possibilities.
Fair point. We don't have to agree on everything here on the podcast. So we do. And interestingly enough, you kind of said it yourself when we talked about Bitcoin, right? We have Rob, we have you, we have Jerry, and you have 3 different positions. So we are all doing things a little bit different for sure. Let me move on to the last question from Babek. And he writes, third, when working with a system which does allow a flat position in individual underlyings, we can come to the extreme of having no positions at all. This obviously will be even more the case when the system happens to be long or short only. As rules-based investors, we would not have a problem with this as we just follow our own rules. However, managing overall exposure can still be an open question on the way from many non-flat signals to all flat. Do you have a view on scaling and down existing positions depending on the performance of your entire portfolio, which would lead to additional leverage when many non-flat positions exits and do well? Or alternatively, give us higher exposure to performing assets when we do not have a large number of non-flat signals. I think what you're alluding to here, Babek, is whether we would borrow risk, or we would increase positions if we have fewer positions on. We would increase the size of those positions to compensate for a lot of markets being flat. All I can say is from what I've seen, so in all of my career and all of the systems I've worked with, that's not something we would do. And you can hear Moritz is agreeing with that.
Don't get me started on a Friday night. I need a glass of whiskey to go. No, please, don't do that.
Yeah, and I think, again, and we don't know exactly what your portfolio looks like. I think the best way to avoid, going to basically no positions is to have more markets in your portfolio. But I will also say, and I mentioned that in the last couple of episodes, that for my own trend following model, given the sell-off we've seen recently in many of the commodities, I was stopped out of many of those commodities, so that the portfolio has become much more concentrated in energies and equities, frankly, with a few extra positions. So far, it's worked out fine, but there is a risk your portfolio is going to be reduced in terms of number of positions from time to time. It will never go completely flat, in my case, certainly, but yeah, it's just how it is.
Exactly. There's no reason to increase your risk on existing positions just because another position has stopped existing or is not coming into existence. You would be destroying essentially all your statistics, all the normalization that I like to think about in ATR terms or R terms, and having a defined risk number of equity on each trade. You would throw all of that valuable stuff out of the window. I can just say, please don't do it. Yeah, well, I don't want to say please don't do it. I recommend I would not do it.
Exactly. I think that's fair. Moritz, anything you want to bring up before we move on to look at the industry performance? Anything you want to highlight in terms of...
No, it's been great catching up. Yeah. We didn't speak a lot about Bitcoin, which is good. Maybe next time.
Yeah, we'll do that next time for sure. And of course, the fact that we're already 1 hour and 10 minutes, so it's not like it's a short episode, even though time runs fast. I did notice the score. The Swiss and Spain are 1-1 going into probably penalties, so maybe it's a good time to wrap it up and head back to the
I'm talking too slowly. That's why it's always so long.
Well, there we are. But before we do so, of course, the BTOP 50 index in June ended down about 1.03%, still up 6.08%. The SocGen CTA index also down 1.03%, up 6.55% for the year. SocGen Trend Index down 2.12% for the month and up 7.5% for the year. The Short-Term Traders Index was down 48 basis points, but still up 1.04%. And as I said, at the end of June, my trend barometer finished at 48. So it's kind of a neutral setting, I would say. And I would expect that the indices, that the industry is going to come out with some red numbers this month. Anyways, MSCI World Index was up 1.4%, so that seems to continue, up 12.16% for the year. And the bonds, the Global World Government Bond Index, up 53 basis points in June. I think that does it. Let's wrap up this conversation. We hope you've enjoyed it. And as I said earlier on, we would really highly appreciate if you would go and leave a rating and review like so many have done already. But it really helps because the way the algorithms work in the podcast industry, rating and reviews go into your ranking. It's not just how many downloads you get. So we would appreciate if you would take a little bit of time out to do that. Next week, I'm joined by Jerry. So make sure you keep your questions coming. And you can, of course, email them to info@toptradersunplugged.com. We'll do our best to get them up. And yeah, I think that does it from Moritz and me. Thanks so much for listening, and we look forward to being back with you next week. In the meantime, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.